accounting structures. So you've got the tax aspect and then you've got the financing aspect. So you've got to work them both in together. So I go to the accountant first and ask him what my best structure is, and then to the financier, and then you'll likely have to go back to the accountant and then back to the financier. So for all you guys, all the other guys that are doing this, if you haven't already, chances are you're going to be bouncing between the two to get the best structure, and you got to make the final decision on that, because you're going to have to compromise on some things. So this is the compromise, or in your situation. So look, my personal structure is that I have a proprietary limited company which owns one property, and my shareholder so this company owns the property, or in some instances it's a trust, but 99 for my old developments it's all companies. This company owns the property, so you need to have a shareholder of this company. So most people put themselves as a shareholder, which is fine. You can put yourself personally as a shareholder, or you can use another line. So I have a company that's a shareholder, and then I have a company and trust that's a shareholder. So I've got a couple of lines up. Now this structure is expensive. You guys probably aren't going to be putting this together first time around, and I didn't. But this does provide asset protection and provides ultimate flexibility. So this structure means that you can pay tax here, you can pay tax in this structure, you can issue dividends, and then you can pay tax here. And then it also means that you can issue dividends again from this company up here. So you're not going to be doing this structure, I don't think. I wouldn't be doing it if you're playing with hundreds of thousands of dollars. I wouldn't be doing this structure. This is just, if you're in millions, I think it's probably worth setting this up. So what you can do is get rid of one line. So Peter, in your instance, I think, and the reason why it got brought up is Matt was talking about financing. Lenders not liking financing where the shareholder is a company and trust. So basically I just took out one line. So now this gives you flexibility where either the company can get taxed, so the company can pay the tax rate, which is like 25%, or you can distribute dividends to, and this is a trust and company, or you can distribute to here, and with trust, you can distribute to individuals and family members. So that's what the accountant says. Hey, this is a really good structure for you. It's going to cost you, that's like a $3,000 setup for that, by the way, something like that. But it gives you all this flexibility. And then when you want to do another project, you stick another project off to the side, and then you do the next project. And that's likely what he said. Now, the issue and why Matt raised it is he said, oh, all these major banks, they don't like this structure. They want you to be, instead of a company, a shareholder, they want a person. So this is for the major banks. So they want a person to be shareholders. They want some individual. And I don't know the reasoning behind that. Maybe it's too complicated for them, and their brains just, you've got people in credit that are juniors, a lot of them. Maybe it's just too hard and they've just drawn a line in the sand. So that's what the major banks want. And then Matt basically said, look, if you do that other structure, chances are you're going to be into second tier lending. So your rate's going to be a bit higher. So you've got to make that decision, which way you go, which is going to be more beneficial for you. So that's your decision to make on your circumstances and whatever. Personally, I like the multi-structures, but for the first deal, maybe it's not worth it, like setting up the extra structures, or maybe you want to roll that structure into doing something else, and maybe it's worth paying an extra, whatever the extra interest is. Maybe it's $5,000 of extra interest just to have like that buffer. One thing just to remember as well, whether you have a company here or whether it's a person, so this is proprietary, whoever these beneficiaries are, so if they're listed as beneficiaries on the trust deed, or if they're listed as individuals as the shareholding, whoever these people are that are involved in this company or this trust or as shareholders, the bank is going to stitch up all of you guys. So only have one person, if you can get away with one person leaving serviceability, only have one person in this structure. So that the bank is only going to stitch up. So by stitch up, I mean I'll sign a personal guarantee. So only have one person. If there's another person involved, have them sitting off to the side and have a JV or a shareholders agreement or whatever the lawyer wants to call it, but keep them separate, like keep them out of the equation so that the bank only sees this structure, because whoever is privy to this structure, and normally the cutoff is 20%. So if somebody has 20% shareholding in a structure, the bank will want normally personal guarantees, but I've seen major banks want personal guarantees for people with 5-10% shareholding. I heard about a structure where there were 15 people up here and the bank took a personal guarantee for all of them. So what do 15 people own? 6% or something. So the bank will just grab anything they can. And in the current market, just with the lending the way it is, because it has contracted, the banks will want even more than what they normally would want. So they'll find every reason not to loan you the money. So they'll say, we want personal guarantees for every single shareholder. If you don't sign it, then we're not going to lend you the money. End of story. And they don't care. Like they're making billions of dollars. So they're like, oh, what's your $1 million or $2 million loan mean to us? It's nothing. So yeah, you just got to make a decision which way you're going to go. So you've got the accounting side of things, and then you got the finance. And 9.9 times out of 10, I go down the financing route, because without the financing, I personally can't do the project, or I'd rather pay a little bit more for the financing and get more money or be able to do more projects rather than save some money on tax.